Welcome to the second installment of the Momentum Investments Global Citizen Masterclass series. I am excited about today's discussion, and we hope this will give you deeper insights to formulate a solid advice framework for your global citizen clients. Just some housekeeping: we applied for continuous professional development, or CPD points. It's important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on the platform at any time until the end of October and still receive your CPD points. The CPD certificates will be mailed to you during November. Please feel free to ask questions in the Q&A sections, and our speakers will either answer them live or get back to you after the event. You will also find more information about our speakers under the Speaker tab on the top of the menu bar, or if you scroll down, you can download the PDF presentations. Please engage with our speakers and enjoy the event. First up, Sharon Hamann, Senior Legal Advisor with Momentum Distribution Services, and Madeleine Schubert, Local and International Tax and Fiduciary Specialist. They will be joined by Corlia van der Merwe, Arthur Kander, and Neil de Preer. Their discussion will provide valuable insights into determining the tax residency of a global citizen and the importance of this in setting up a global financial plan.
Thank you, Francois. Madeleine and I will discuss the importance of considering a client's tax residency status when giving financial advice. Tax residency, obviously, as we know, dictates where your income is taxed, and that is generally based on residence, because most developed countries base their tax systems on residency. On the flip side, it's also important to know where a client is considered a non-resident, as it can result in source-based taxation being triggered. So for this purpose, perhaps we should start building a client, and we can then apply the rules as we go on to see how it evolves if the client's life starts evolving as well. Madeleine?
Yeah, I think that would be probably a very good idea, and maybe we can have a Mr. X and a Mr. Y. So we could potentially have a Mr. X that was born in South Africa and was raised here and studied and worked here, and then planning to start working internationally. And then we can look at Mr. Y, that was a foreigner that came to South Africa and had spent a lot of time here, maybe 7 years, and become a deemed tax resident. And then he started traveling again outside South Africa. So maybe we can explore then, let's then add a bit of dimension to this question, and we'll say Mr. X goes to UK and Mr. Y explores Australia.
Yes.
And then we can see what is the considerations that we need to have, because both Mr. X and Y is going to be married and they're both going to have kids. And these kids are also now looking at global trotting and go explore the world.
That is something that we're picking up quite often these days, is where we have South African clients making decisions, not considering the tax residency of their children, that can have a direct impact on some of the choices that they make. I think maybe let's go over to Neil de Preer.
Okay.
He's going to give us a bit of background on the rules for South African tax residency, and then we can come back and discuss it a bit.
That sounds good.
Thanks, Sharon. In South Africa, we have a residency-based tax system. This means that a person's tax residency status in South Africa will determine if they are taxed on worldwide income or only income earned in South Africa. Tax residents are taxed in South Africa on their income earned anywhere in the world, whereas non-tax residents are taxed only on income from a South African source. Our Income Tax Act contains a test that is applied to determine whether or not a person is a South African tax resident. The residency test is two-pronged. Firstly, we have the ordinarily resident test, which is based on the intention of the person as well as their personal circumstances. Secondly, we have the physical presence test, which is based on the number of days that the person has been physically present in South Africa over a 6-year period. When implementing the tax residency test, it is important that we consider any double tax agreements that might be in place between South Africa and another relevant country. Once a double tax agreement, commonly referred to as a tax treaty, is approved by Parliament and published in the Government Gazette, it has the same effect as if enacted by law. In terms of the definition of a resident in the Income Tax Act, a person who is deemed to be exclusively a resident of another country for the purposes of applying any tax treaty will not be a tax resident in South Africa, irrespective of the outcome of the tax residency test. You always need to consider the ordinarily resident test first, and only if a person does not meet the requirements for this test do we look at the physical presence test. The ordinarily resident test is a subjective test, and each case must be dealt with based on its own merits. The following are some of the factors considered when determining whether a person is ordinarily resident in South Africa. Does the person intend to have South Africa as their ordinary place of residence? Does the person consider South Africa to be their home? Where is the person's habitual abode? Where do they stay most often, and where is their social life based? Where is the person's home, work and possessions based? Where does the person return to after traveling? This is not an exhaustive list, but the answers to the questions will provide a good indication. If a person's intention to be a tax resident in South Africa changes, and there are circumstances supporting this change, the person will no longer be a South African tax resident. In this case, the individual will inform SARS of this change, which will have certain consequences that Madeleine and Sharon will discuss during today's session. If a person is not ordinarily resident in South Africa, we need to consider the physical presence test to determine tax residency. This test is based on the number of days that a person has been physically present in South Africa and is applied over a 6-year period. Let's take a look at the requirements for the physical presence test. The person needs to have been physically present in South Africa for at least 91 days in aggregate during the relevant tax year, and 91 days in aggregate during each of the 5 preceding tax years, and 915 days in aggregate during the 5 preceding tax years. If all 3 requirements are met, the person will be a South African tax resident. Let's look at it practically for the tax year ending February 2024. The person must be present in South Africa for at least 91 days in aggregate between the 1st of March 2023 and the 29th of February 2024. And the person must also have been present in South Africa for 91 days in aggregate during each of the 5 preceding tax years. Thus, each year between the year ending in February 2019 and the year ending February 2023. And the person must have been physically present in South Africa for 915 days in aggregate between the 1st of March 2018 and the 28th of February 2023. If all the requirements are not met during a tax year, or if the person leaves South Africa and is absent for a period of 330 days or more, that person will no longer comply with the requirements of the physical presence test, and they will no longer be a South African tax resident from the day that they left South Africa. Tax residency is vital when giving financial advice to multi-jurisdiction clients and can be tricky to determine. As a financial advisor, you are not authorized to determine tax residency or give specialized tax advice. It is therefore important that you refer your clients to the appropriate specialist when there is uncertainty regarding residency. Thanks, Sharon. Back to you.
Thank you, Neil. So Madeleine, looking at the tests, it's clear that the intention of the taxpayer and the surrounding circumstances are obviously very important in determining where they are resident. And if we look in the South African context, ordinarily resident is obviously the first test. And if we look at your clients that we've now brought to life, Mr. X and Mr. Y, what would you say you would look at to determine if they are ordinarily resident in South Africa?
So with my first client, Mr. X, he's born and bred in South Africa, and if he's had his wife, they're married here, their home is here, their connections are here, economic and personal, and he spent habitually most of his time in South Africa, he will remain South African ordinary resident. Mr. Y, on the other hand, if he wasn't born and bred in South Africa, and he came to South Africa, typical what they call inbound expat, then he could have formed South African tax residency by intention, but that's often not the case, because often if foreigners come, they come for a set period, and in their mind home is still UK or Australia. So therefore we developed South Africa legislation to bring those people into the South African tax fold. That's the physical present test.
Okay.
Now this one is time-based, and it's easier to measure because intention is always difficult. You can change your intention about anything with a flip of a switch, and it's not so always true what you convey as your intention. That's where the facts need to support the intention. So the physical present test is time-based. Now what I have found in practice is that people that are ordinary resident and that's caught in a physical present, there's a bit of confusion. Then how do we get out of the system? So the golden rule is really this. If you come in as an ordinary resident, you can only go out as an ordinary resident. That means change of intention.
Okay.
If you're caught by the physical present test, you can only go out by the physical present test. And that's at 330 days where you're physically out of South Africa for a year, about a year.
Okay, so that would only
Yes.
apply if I was physically present, and
Correct.
that resulted in my residency.
Correct.
And now I leave, and I
Then
have to stay out
automatically
for
by
330.
time out of South Africa, you exit the system.
Okay, if I'm ordinarily resident, and I
You
say I'm no longer,
That's it. You can only go out
Cut
in
price.
one of two ways. The first one is change of intention. So we need to prove that there was a shift internally, supported by facts, that you are leaving South Africa. You sold your house, you bought a new house somewhere else, you started to work there, or there's a legal reason for you to be in another country. So we start looking at those facts. And then we can say there's a clear shift in the guy's intention. And if you can remember the legal cases, the ipsy-dixie, your
Yes.
ipsy-dixie,
yes.
my own witness of my own affairs. So that is important with change of intention, and we got to support that in practice with facts, with evidence. So that's very, very important. The other way an ordinary resident can get out is when you go spending physically time in another country, like the UK or Aussie or wherever you go, and you get caught into their domestic system. Now you're tax resident there, but you're tax resident here. And then we jump to the international agreements,
Yes, that's
which
what-
gives us our rules.
Yeah.
Yeah.
So Madeleine, if we look at client X is a South African resident. He was born here, he's bred here, his family's here, but they are now moving, let's say Australia in this example. He is now going to take his whole family and he's going to go, so he's ordinarily resident, and now he's changing his intention. He's got a job there, he's applied for the visa, he's got the house, the kids are enrolled in school, so all the circumstances in fact support the fact that he's changed his intention. He doesn't want to stay here anymore, he wants to stay there. What are the implications from a tax point of view for him to do that? And maybe just one step back, when should he tell SARS that this is what he's doing? Should you coincide it with the tax year? Because obviously if he does it mid-tax year, that tax year as a resident stops and tax year as a non-resident starts. Or should he tie up certain affairs? In your experience, is it better
Okay.
to maybe tie up certain affairs before you do the whole formal exit from a SARS point of view? Or doesn't it really matter?
So with Mr. X in his case, so if he goes to Australia and he's in South Africa and he has his own assets in his name and he's got a family structure, maybe a trust with an underlying company. Typically, high network clients will have at least that basic structure. So when you're planning to go to a country, for example, Australia, and he will at some point trigger their domestic rules, then there's a lot of advanced planning for somebody like that, because Australia's got very harsh rules with trusts. Now, the first thing that is potentially problematic for him is if he's a trustee on a trust, or his wife, and they move to Australia, just by being a trustee on a trust will trigger tax residency for the trust in Australia.
Yeah.
So now, and I had actually was one of my first law cases when I started practice, was this trust that by default was migrated to Australia, but it was still tax resident in South Africa. And then we had a huge battle to see if the double taxation agreement applies to a trust in such a case, which was very tricky because a trust is not always defined an international agreement as a person. So it gets quite technical. Some will say a trust is not a person. So you could see, so it was a very problematic case where we eventually had to write to both authorities to say, help.
Okay.
So it's a mess. So the shortcut is resign from a board of trustees if you're going to a country like Australia, or actually for any other country, because that is, if you have the majority of your board, yourself and your spouse and an independent, if you move, you'll move your trust anyway for tax residency to different jurisdictions. So if you want to keep your South African trust, look at your board of trustees, either appoint an extra independent person or family friend to have the majority of the board in South Africa, or both, ideally resign.
Okay.
So in the case of Australia, I will take it one step further. I will actually just terminate the trust structure.
Oh, but that comes with its own.
And
Tax
that comes with its
consequences.
own tax consequences, because now you must remember with South African tax rules and trust, if you're a South African tax resident, we can vest a capital gain in you, and for the time being, which is about to change, we can vest income in you.
Yes.
Now, the first bit is already, so the reverse is also true. So we can't vest a capital gain in a non-resident. And at the moment, as we sit, we can vest income in a non-resident, but it's in the latest bill, which is about to be discussed at the moment, where they're going to change that as well. So as a non-resident, all the income that's going to go to you in a different country is going to be taxed in South Africa, and it's harsh. Now, capital gain is a 36% haircut, and then income tax potentially 45%.
No,
So
that's severe.
that's severe. So then,
Can I
yeah.
ask you a question though? If you were now doing a plan, and this is just a question because I know some of the advisors will probably be thinking this.
Sure.
My client's got the trust in South Africa, it's got assets, maybe more investments, not necessarily fixed property, and maybe some shares in his company or even listed shares. Would it be something to vest the assets in a trust for the benefit of these beneficiaries, but in a foreign jurisdiction like a Guernsey, where you don't have a local trustee, where the trust company is the trustee? Will you be able to exit the assets that way and thereby limit the implications to some extent, or not?
Well, this is quite an interesting question. So in theory, but again, you must look at the different jurisdictions. So if we worked with not as Australia, but in something else, in theory, you could change the trustee to bring in a foreign trust as a beneficiary. But again, it will be non-res. So, and SARS a while ago approved that, but it will still trap the tax here.
Yeah.
And ownership can go then potentially over, and then the tax residency obviously will change. But so in theory, you can get there, but you need Reserve Bank approval, which will make it much more difficult.
Yes.
So the smart thing would be, if you're going to go to a problematic tax jurisdiction with trust, would be to terminate your SA structure, take the lower vesting tax rates in your name, and just terminate our structure. So if your vest in your name is 18% versus 36, you know that story.
Yeah.
So it would be the smarter thing to do. Or I actually have a client in that position at the moment, because in their mind, they applied for a business investment visa in Australia, and he's built up a trust with a holding company of a lot of trading businesses under it. And then he came to me and wants a Mauritius structure because he read about it somewhere. So I said to him, you know, I won't do a Mauritius structure for you because it's going to be taxed so harshly in Australia. And I said, by the way, do you realize your South African structure is going to be seen as foreign as well? Oh, the poor man.
Yeah.
So in his case, what is driving that family to go over is because his son is going over.
Okay.
So I said to him, in his case, because the business is also such huge value, for him it is a case where it's better off to go 6 months Australia, 6 months South Africa, and don't change your tax residency. Maintain your dominant home in here.
Okay.
Because the structures or the cost of termination of those businesses would be huge until the point you sell it to a third party and you take your money and you go.
Okay, so that
Yeah.
shows that just to change your tax residency is something that actually you need to put a lot more thought into it than just actually making that decision and saying, I'm going,
Correct.
terminate tax residency and think about the problems that come
Correct.
later.
But it's also his age. So this client, if I had to call him now Mr. X, he is 50. So for him, physically, he would be able to still to travel between two countries. But at some point, you get tired and you're going to get older and your body doesn't want that flights. So at that point, you're going to have to settle. And the tax will come at some point. But it will give you
time.
time.
Yes,
Time to
plan.
slowly take stuff out.
Okay. Madeleine, if we look at the South African resident, he's a South African tax resident, he's got most of his assets in his own name, he doesn't have the structures, but he's got a house, a couple of investments, bit of cash, nothing fancy, but he's got a nice pot of or assets that he wants to take abroad. He's terminating his tax residency, not really thinking about it, and then comes a realization there's actually an exit tax in South Africa, and that is in the form of capital gains tax that is triggered because terminating your tax residency has a deemed disposal as a consequence. So immovable property is excluded, and some business.
Yeah, so it's mainly movable property. Maybe so 3 years ago you could have excluded, but I changed the law. We held an investment in a property company. So you had to hold at least 20% interest in a company, and 80% of the underlying company, 80% of that value is attributable to fixed properties. Now that one they took out. So a lot of my clients have been caught in the past because in their mind they think property it's excluded, but it's not. So where you hold shares, for example, in a company that has this underlying fixed property, factories, for example, then on immigration you pay capital gains tax. So your shares then get a step-up base cost, but this is now the weird part, that specific type of property stays in the South African tax net. So now you must realize if you one day sell it and you don't sell the shares, but you're selling the underlying property, you might pay double tax because you've had your step up on the shares. So that's exception. That's like a terrible scenario. So I've got a few clients that have properties or factories or buildings in a company, so property companies. So they had to pay capital gains tax, and when they sell it, they're going to pay technically again. So it's a very, very expensive way. And if you sell the underlying property out of the company, profits is then taxed in the company, but then you're still going to get it out. So that's your extra layer of 20% there, or versus selling the step-up shares and take it out. So that's a bit of planning between a buyer and seller. Yeah, and the other important one is where you do have fixed property that stays in South Africa net, you will only pay capital gains tax when you sell it. But if you sell it as a non-resident, another layer of laws coming in is a temporary withholding tax legislation. So that is when you sell a property as a non-resident, depending on the legal nature, so if you're a trust, company or individual, there's different withholding tax from the proceeds. So for individual, immediately the attorney or conveyancer must withhold 7.5% of the proceeds and pay to SARS in 14 days. Otherwise you face a penalty. That's very harsh. And then if your workings show that your proceeds are much more than the actual gain, then you've got 12 months to submit a tax return as a non-res on source basis and claim and then disclose the gain or loss, and you can get some of that money back.
So that means you have to complete a tax return. So that means you have to be registered as a taxpayer.
Correct. So if you were in the system, it's fine. But as I think I've told you the other day, I had Americans that were selling a property, and to get somebody registered in South Africa, it turns out to be a nightmare. You would think SARS will wait for these people. Yeah, no, it was unbelievable because the people sold a place, a lodge in Kruger, the two Americans, so they automatically, because of the American status, they will always be American taxpayers. So now we did the withholding tax, but to pay the withholding tax, you've got to be a South African registered income taxpayer, which doesn't really make sense.
So just to pay the 7.5%,
you have to get a South African tax number, and to get a foreigner register again, this local SARS office wanted them to present themselves at the branch, but they're sitting in America. So you could see the frustration levels.
What was the solution?
So eventually I actually asked a debt collector lady to help, and she got him registered in a day because they wanted the money. Yeah, so the processes are frustrating. Yeah, but it's very frustrating, and that legislation really doesn't make sense, but it is there, and its penalties are high. It's quite high. Yeah.
So let's go back to Mr. X, because as we know, he's now gone to Australia. So I think maybe it's a good time to switch over to Arthur Kander, one of our other legal advisors in the Momentum Financial Planning space, who will give us a high-level overview of what Australia looks at when they determine tax residency.
Thank you, Sharon and Madeline. Australia is a residency-based tax system. The rules which we speak about today is for the 2022-2023 and 2023-2024 financial years, which run until 30th June 2024. The Australian Tax Office, which will be referred to as the ATO from here on, is the body which collects income tax in Australia. They also determine the residency test, which are currently based on 3 situations. The first test is to determine the domicile of the individual. If the individual is domiciled in Australia, they can be resident in Australia unless they have a permanent place of abode outside of Australia. Their domicile can be based on their origin, meaning the place where they were born, unless they have chosen to renounce their domicile of origin. A person who does not originate by birth in Australia can also intend to make Australia his permanent place of abode and his intended home in Australia. Then in that case, Australia would be his domicile of choice. The second test is where the ATO will consider the individual's temporary residence for tax purposes, and this is broadly for individuals who hold a temporary visa under the Migration Act of 1958, is not an Australian resident within the meaning of the Social Security Act of 1991, and does not have an Australian spouse as defined in the Social Security Act of 1991. Once a person is awarded a permanent residency, the visa will fall away. The third circumstance under which the ATO will collect income tax from a resident individual is if either the individual is temporarily or permanently resident and the individual is an eligible employee for the purposes of legislation relating to superannuation entitlements, meaning that this person belongs to a pension scheme of the Australian government. Similarly to South Africa, an Australian tax resident is subject to Australian income tax on his worldwide source of income, that is, income from both Australian and foreign sources. Nationality and citizenship does not determine liability for Australian income tax. Temporary residents will be taxed on his worldwide income, but will be exempt from Australian tax on foreign source income. Australia's tax treaty arrangements with certain other countries contain special rules for determining the jurisdiction to tax specified types of income. Most treaties contain tiebreaker rules which seek to overcome situations where an individual is treated as a resident of both Australia and the other treaty country. The determination of resident status under these tiebreaker rules override the operation of the general resident status rules referred to above. A non-resident is liable for Australian income tax only on income derived from Australian source, other than interest, royalties, and dividends, and certain other statutory income that is taxable on a basis other than source, such as capital gains. Reside means to dwell permanently, to have one settled or permanently abode to live. The factors which will be considered, therefore, will be the intention and purpose for the presence of the individual in Australia. Is it for work or play? Family and business or other employment ties? Maintenance and location of assets? How many fixed property does the individual have in Australia and the purpose for its use? Social and living arrangements such as memberships to the gym and social clubs, there must be a degree of continuity and permanence in habit. The test is very similar to the ordinary residence test in South Africa. If a person is domiciled in Australia, tax residents, unless their permanent place of abode is outside of Australia, in which case the place where they reside and domicile are not met. There are three types of domicile: the domicile of origin, the person's place of birth or his father's place of birth is Australia, the domicile of choice, is there a change of residence, and is the person's intention to make Australia his permanent home indefinitely? Domicile by operation of law. If one elects to abandon the domicile of choice, the domicile of origin will be his default domicile. Therefore, if an Australian goes abroad, they will retain their domicile in Australia unless they decide to leave Australia on a permanent basis and make the place of their choice to call their home, and that place of their choice will be their domicile of choice. What is the 183-day test? Individuals who have actually been in Australia for more than one half of the income year, that is at least 183 days of the income year, and unless that individual's usual place of abode is outside of Australia and the individual does not intend to reside in Australia, they will be considered a tax resident. What is the superannuation test? If a person is a member of the public sector superannuation scheme or the Commonwealth superannuation scheme, then the person is an Australian tax resident. In this case, their spouse and children will also be seen as residents. This is done to ensure that the government employees working abroad remain in the tax net. These funds are now closed to new members so that the test only applies to existing members. The Bright Line test. The then Australian government announced in its 2021-2022 federal budget that it will replace and modernize tax rules for determining individual tax residency. There has been a change of government since this was first announced, and it remains unclear whether the proposal will proceed. However, if the measure is enacted, as originally announced under this proposal, there will be a new primary Bright Line test, where the individual will become an Australian tax resident if they are physically present in Australia for 183 days or more in any tax year. Where the individual does not meet this primary test, secondary tests will apply. The secondary test will set out the objective criteria, for example, whether an individual has the right to reside permanently in Australia, whether they have Australian accommodation, family located in Australia, or Australian economic connections. Enactment of enabling legislation, that is 1 July 2024 at the earliest. Tax residency is vital but can be tricky to determine. Clients should know if they are Australian residents or domicile. As a financial advisor, you are not authorized to determine tax residency or to give specialist tax advice. Refer your client to the appropriate specialist where there is no certainty. Thank you very much.
Thank you, Arthi. It's obvious that some of the rules are very similar to our rules, but it's also quite different. And like Mr. X, he obviously had to choose a certain type of visa to go to Australia, and some of them have certain requirements attached to it. And I suppose that's maybe where the temporary residents come in that Arthi spoke about. So in certain situations, might it not be better for a client to actually retain his tax residency in South Africa whilst he sorts out his visa requirements on the other side, rather than having to go to and fro if it doesn't work out on that side? What does your experience dictate?
So I think with a client like that, I mean, if he goes over on a temporary visa, so it will be a little bit tougher to convince our authorities that there's a pure intention to go. So a bit like this, the immigrations that you go to Dubai, because you can never become a citizen or you can never get a nationality in a Dubai, for example. So you've got to really prove that the line with South Africa is broken. So if he goes to Australia with a temporary right, 2 to 5 years, right to stay there, subject to evaluation, it means Australia can kick him out after a certain time. So then where do you go? So then you've got to think of right to legally be somewhere. So what is that? That's a passport or another visa of some sort. Now, if your only other right is to be anywhere else in the world, is in South Africa, you will come back. So maybe in those cases, it's not necessarily a bad idea to stay in the system, save yourself from paying exit taxes. But if your balance sheet is mainly cash or you have no access, then obviously it can change. But if you've got a costly immigration, then go over, do the visa temporary thing and maintain your tax residency. I would.
Okay.
Saves you that tax, because you're never going to get that tax back.
Yes.
So if you don't meet the requirements in Australia and you have to come back, now you've paid something and you're out of pocket and it's expensive.
Yes.
Yeah. But once you satisfy their requirements and you can get a permanent residency, then let go of here.
Okay.
But you then, again, that's just a right to be there. So you must make sure that you keep then enough substance in South Africa as well to keep ourselves
keep the residency.
To keep the residency, yeah.
And then what
Yeah.
about situations where you've given it up, but you don't meet any of the tests on that side? Now you like in no man's land.
Yeah, so you can legally, if they kick you out of Australia, and you can only come back to South Africa, you come back. There's no such thing as failed immigration anymore. They took that away from exchange control perspective.
Okay.
Then you come back, and then at that point of entering, you're deemed to sell your assets at market value and immediately reacquired at that cost. So then you just have a step-up base cost for the assets that you now and you have in your name.
Okay, so as we spoke earlier, a lot of the immigration agents just make people very excited about leaving South Africa, but it just shows that from a tax point of view and from a financial planning point of view, we have to guide our clients to actually consult with the right people and to look at the big picture before just going because they just want to leave and they want to go and start a whole new life.
Absolutely, and there's still in practice a lot of confusion about the legal right to be somewhere and tax residency. People confuse so much about, but I'm allowed to go there, but it doesn't mean you're going to be tax resident. Remember what we discussed, there's different rules in each jurisdiction.
Yes.
So you've got to meet those rules, whether you're allowed to be there or not, basically. So if you're there for those rules, you'll get caught. It's not about being there physically or the legal right to be there.
Yes.
So it's different test, it's different professional, and it's got different consequences. So, yeah.
I think it's a good time to switch over to Corlia van der Merwe, legal advisor with Momentum Distribution Services here in Gauteng, who's going to give us a bit of detail on the UK system and what they look at to determine tax residency. And the reason I want to do that is because I want to come back to client Y, because he's now in South Africa. He's lived in the UK his entire life. And that has some implications because we're not used to thinking about domicile, but the UK does. They don't just look at residency, they look at domicile. So let's go over to Corlia and she can tell us a bit more. Over to you, Corlia.
Thank you, Sharon. Thank you, Madeleine. How do you determine if your client is a UK tax resident? In the UK, the residency-based tax system applies. People who are both UK domiciled and UK residents are taxed in the UK on their worldwide income and capital gain. If a person is a resident in the UK but not domiciled in the UK, the remittance tax basis apply. This means that you pay UK tax on UK income and UK gains, but only pay UK tax on foreign income and foreign gains if remitted to the UK. Where a client is a non-resident, and often this is the case with our South Africans living in South Africa, the source-based tax rules apply. Income from UK source will be taxed in the UK. Let's first look at residency and discuss domicile a bit later. So if we look at residency, the statutory residency test, the SRT, is the test that will determine residency. A person is a resident in any given tax year if they meet the automatic residency test. A person does not meet the automatic residency test, but meets the automatic non-residency test, they will not be a resident for that tax year. So if a person does not meet either of these above tests, then the sufficient ties test are applied to determine resident status. Let's unpack the automatic residence test. So if you've been in the UK for 183 or more days, you'll be a UK resident, and there's no need to consider any other tests. The home test is the second test, where there was at least one period of 91 consecutive days when you had a home in the UK. So the third test, 365 days employment test. This is where the client is employed full-time with no break in employment in the UK for any period of 365 days in the tax year. And then if your client passed away in this tax year and were automatically resident for the last 3 years and the UK was his home, your client will be a UK tax resident. So let's confirm. If your client meets any of these automatic residence tests, they will be considered a UK tax resident. Thank you. Another aspect to the statutory residence test is the automatic non-residence test. The first test there is the 16-day test. Your client was a UK tax resident for one or more of the last 3 tax years, but spent less than 16 days in the UK during that tax year. Or the 46-day test. Your client was not a UK resident and during any of that last 3 tax years and spent less than 46 days in the UK during this year. And then there's a third test, a 365-day employment test. But this is where your client worked full-time outside of the UK and worked less than 31 days in the UK and spent less than 91 days in the UK during that year. And then if you're sitting with a situation where your client passed away during this tax year and was not a resident during the last 2 tax years and spent less than 46 days in the UK during the year, your client is not a UK tax resident. So to confirm, if your client meets any one of these automatic non-residence tests, your client is not a UK tax resident. The statutory residence test further evolves into a sufficient ties test. And this is a scenario if the client does not meet any automatic residence test and the client does not meet the automatic non-residence test. So then the next test applies. And this is the sufficient ties test. The test refers to the client's ties or connections with the UK. And during this tax year, and these ties plus days spent in the UK will determine if your client qualify as a UK tax resident. The different sufficient ties that we're referring to is family ties, accommodation ties, 90-day ties, country ties. But if your client was not a UK tax resident for at least one of the 3 preceding tax years, they can ignore the country tie. The more days spent in the UK, the less tie tests have to be fulfilled. So one tie must be fulfilled if they spend more than 120 days in the UK during the year. Up to 4 ties must be fulfilled if they spend less than 46 days in the UK during the year. If the sufficient tie test is met, your client will be a UK tax resident. When we started the discussion on UK tax residency, we referred to domicile and residency. Now, tax residency is determined annually for a specific tax year. Domicile is more permanent, where you belong, where your home is. A domicile is usually established through parents, your father. So domicile of origin is where a person is born. And you can renounce your domicile of origin and select another. If a person is domiciled in the UK, they will be liable for tax on worldwide income and worldwide gain in the UK. It's also important to take note of the concept of deemed domicile. If a person is a non-resident but a deemed domicile, they will pay on the worldwide income and gain in the UK. They are not entitled to select remittance basis of tax, and a client can be deemed domicile if either of the following are met. They're born in the UK, and the UK is domicile of origin, and they're resident in the UK from 2017 to 2018 or later years. So for tax purposes, a person with non-UK domicile will be deemed domiciled in the UK once resident in the UK for 15 years of the last 20 tax years. So when a client is a resident but not domiciled in the UK, the domicile status is very important. And if a person is a resident but not domiciled in the UK, they can select the remittance basis of tax. So foreign investment, income, capital gains and certain earnings taxed abroad and will only be taxed in the UK if it's remitted to the UK. And this is not applicable if a person is deemed domiciled in the UK. To determine if a client is a UK tax resident, it's vital but can be very tricky to determine. Clients will usually know if they are UK tax resident or domiciled in the UK. From an advice-led point of view, we urge you as financial planner not to determine tax residency or to give specialist tax advice. Refer the client to appropriate specialists where there is any uncertainty. Thank you.
Thank you very much, Corlia. So, as said before, domicile is something that we don't really focus on from a South African context. And if we look at our client Y, he lived in the UK his whole life. He probably came here to work, as you mentioned. He brought his family. He's been here for 7 years. I think you probably used the 7 years because it brings him into the physical presence test. So he's being seen as a South African tax resident from that point of view. But now we still have the fact that his domicile of origin is the UK. He spent most of his life in the UK. How do you think those two will interplay? And now if we look at him building a life in South Africa.
So if he satisfies the physical present test in terms of our law, domestic law here, but the UK, for whatever their rules, is still regard him as tax resident there, then we have to go look at the international agreement between South Africa and the UK. We got to go look at the tiebreaker clause, and probably there's a nice court case as well. That's the Jonathan Oberheimer case, where he had a dispute between South Africa and the UK. Where is his tax residency? Because he had houses here. He's a part of the Oppenheimer family. It's huge properties that side. He had an American wife. Kids study here, kids study there. And eventually South Africa won.
Okay.
Because they could prove that they talk a central or vital interest. I know we're jumping to the DTAs, was majority was still in South Africa. So the UK can lose, even if they decide that he's domiciled there.
Okay.
If the South African is, first of all, court him, physical present test, and the international agreement pushes
Brings
the
him
rights.
back.
Yeah, so Jonathan won based on his nationality at the end of the day.
Okay.
Because the stuff between the two countries was so balanced out, but he only held a South African passport. So that's how
nearly like
he was treated South African, yeah.
Okay. It's important because I actually want to spend a bit of time on the double taxation agreements, which is probably a saving grace, because if it wasn't for these agreements, we would have two countries levying tax on the same amount.
And they will. So remember that story I told you about my first legal case with this trust. So both countries will treat him as tax res. Both countries is going to tax him. Then he needs to go default on accredit systems. So we've got Section 6 quat in South Africa, which means you can claim back credits where you pay taxes. But it's such a messy in practice to do a tax return like that, because you've got to get your wits as well in tow. So you also deal with different tax years. Like I don't know what's the UK, but I know like Australia is a June. Their tax year end in June. South Africa is February. I don't know what's
I think
Jan,
UK maybe isn't it the calendar year? One of them are calendar year and one is April.
Okay.
Yeah.
Could be April.
Yeah.
Could be
Something's
April.
ringing a bell somewhere.
Yeah, so you're working with different periods, so you've got to credit both sides. So it becomes very, very messy.
Okay. So just on the theory a bit behind the double taxation agreements, I think I checked just before this session that we've got 79 DTAs with countries, and from an income tax point of view, we're pretty well covered with the more popular first world type countries.
Yes.
Our next session will probably be on succession planning, and there we don't have that many agreements, but that's a story for another day. And what's quite interesting is that the format of most of these agreements are very similar. So I did a bit of study, and we've got the OECD, which I can't remember what it stands for, but it's obviously an international body that brings all the countries together. And they do a lot of work on these agreements.
Correct.
To make sure that it's fair. And recently I've even read about the BEPS, and I know what that means, the base erosion and
Profit shifting.
profit shifting,
Yes.
which basically tries to prevent double non-taxation.
Yes.
Which is also quite interesting, because if you start reading the double taxation agreements with that in mind, you can now see that they're not just trying to prevent double taxation, they're also trying to prevent where people are very clever in structuring their affairs, that people don't pay tax. And yeah, once again, when we put structures in place for clients, we should take note that these agreements will work probably both ways, either bringing you into the net or making sure you're not into both nets. So it can either be your friend or your foe, I suppose.
Yes, and to make it a little bit tougher now, so South Africa has now part of, or we signed what they call the multilateral instrument,
Yes.
which was an outcome of BEPS.
Yes.
So BEPS, the first BEPS had 15 action grounds. So the MLI is effective now, which means basically if you do whatever you do, and one of your purposes, not the sole or main like tax avoidance, just one of your purposes is to get a benefit from a double taxation agreement, the MLI will go sit on top of it and deny you the DTA benefits.
Oh, goodness.
Yeah, so
Okay.
that's our new world so we're going into. So when we do structuring, if we had to jump to corporate structures now, you've got to be very, your commercial reasons for doing stuff now, it's got to be super strong. And by the way, the tax benefit should just be here. Or we're going to be driven back to the pure tax-free tax havens like your Guernsey, Jersey, places where you don't need a DTA.
Yes.
So that's the landscape, and this area is also changing quite a lot. But for individuals, and as far as I know, the MLI is not affecting the tiebreaker clause. It might be for corporates, like you have with Mauritius, South Africa double taxation agreement, because it's also got the place of effective management.
Yes.
But eventually it'd say, the two governments must agree.
Yes.
Then you're in stalemate situation.
Yeah, because what
It's
if they
messy.
don't want
They
to?
don't,
That's when you
then
go
they
to
don't
court.
agree. Then you've got two countries taxing you worldwide. But for individuals, you still got your tiebreaker clauses, and maybe if you can remember the rules, it's nice to go through those. Because for your client Y in the UK, you'll probably use a tiebreaker clause.
Yes. So Madeleine, if you look at the DTA, it obviously sets out who it applies to.
Yes.
And it generally says that it applies to a resident that is deemed or seen as a taxpayer in a specific country by law. But then, as we've now seen, especially with our client Y, that he can be a taxpayer in both South Africa and in the UK. So you've mentioned the tiebreaker rule a number of times. Can you perhaps just enlighten us what it would entail?
Yeah, so this tiebreaker rules and all the OECD model conventions, which most of the DTIs are based on, is basically set out rules that will say if this, then that. So the first rule is to say if you're tax resident in both countries and you've got a house in one country or a house or home, and it's widely defined, that country will have the taxing right. Now, a home, you don't have to own it. It must just be available to you, and it's something more than just an Airbnb. Okay. The next one is to say if you've got houses in both countries, like our Jonathan character, then we look at the Centre of Vital Interest, CVI. Now, CVI's got two legs. The one is personal, the other one is economical. And then you build like a case. So you'll say, okay, my kids, my wife is with me, the kids go to school, I belong to a soccer club, blah, blah, blah. My financial, I've got still money coming from South Africa, but most of my money is coming from the UK. So you'll start building a case. Eventually, you'll see one will sway, and then that country will win. But if it's balanced, we go to the next test is to say, okay, where's your habitable abode? So your habitable abode is this a whole beautiful French saying, which I'm not going to try to say, but it's where you ordinarily spend, habitably spent as home. So where's home? Where do you spend most of your time? Where do you go? Then that one will figure out. And if you, in both countries, is home, Then we go look at the next one, which is basic to say, where are you national? Where do you own a passport?
Okay.
And if you have passports in both countries, the default is government agreement.
Okay. So in practice, who would apply these rules?
So the tax practitioner will apply these rules.
Okay.
And only if you're in dispute mode with SARS, so if you do immigration or tax of change of tax residence in South Africa and they dispute it, then you'll start going into conflict and then you can apply.
Okay. And then obviously the DTA also gives us a lot of detail on specific types of income. So it's a good guide, but once
Very much
again, people should really consult tax practitioners that are specialized in that area before making the wrong conclusions, because it can be quite easy to do that if we don't take the whole picture into consideration. So I think the purpose of today is really for us to bring home tax residency, why it's important to consider it, that it's not just something we must make assumptions about, and something that is a lot more prevalent these days is what is the tax residency of the beneficiaries, because as you said, Australia does not look favorably onto trusts. I've sort of learned they don't look favorably onto endowment policies. I know the UK have got issues, not issues, but they look more aggressively towards foreign policies than versus local policies. So when doing planning for clients, we have to consider, is this client going to stay in South Africa? Is he planning to leave South Africa? Is this client, his children based in South Africa, or are they already living abroad? Because we obviously see a lot of clients, children like yours, studying abroad, that never come back, taking a gap year, going to work, I don't know, in my day, the kibbutz maybe now in the bars, and they just never come back and find their feet in that sense. They never left though. From a South African point of view, most of them never financially left the country, and I've seen a lot of difficulty around that.
Yeah.
Where they're abroad, we need to send money to them because parents passed away, there's money due to them, and all of a sudden the Reserve Bank says, no, you never left, so you're still liable or still falling into the Reserve Bank limitations of taking
it's
funds
normally
abroad.
a death states. Then you have to basically regularize them at that point of time.
Yes, and they've got nothing in order and in place. So just like your American clients, you're probably going to have a similar situation.
Yeah.
So if today can just bring home that we have to think a bit deeper than accepting that the client living here is the resident and the one that's going to leave is going to not be a resident, because the question is a bit more technical in some instances. I really enjoyed chatting to you. And
it was nice, thank you.
yes, and I hope you guys also did. Thank you.
Thank you, everyone. This was really valuable and highlighted the importance of a client's tax residency in putting together a global financial plan. We would also like to extend this discussion a little further with some more practical perspectives on the topic. Our panel of experts will now give you a perspective on how advisors can bring these elements together into a workable solution.
Thank you very much, Francois. Today's topic certainly piques a lot of interest in the financial planning community, and it's actually very integral in putting together a well-structured global financial plan for clients. With me today to delve a little bit deeper into the subject is Arthi Kander, legal and fiduciary specialist at Momentum Financial Planning, and she is joined by Marius Gillier and Hannes Esterhuizer, both regional managers at Momentum Wealth International. Welcome, everyone. Let's get right to it. Sharon and Madeleine position two very different client scenarios, and I think we can extend a little bit further on these two scenarios. If we look at the family that, for example, stays in South Africa and that maybe has plans to immigrate at some point in future, or even possibly have children that are residing abroad, Marius, in your view, what would be the most prevalent type of questions that you come across when it comes to helping these type of clients?
Thanks, Eugene. The questions has definitely moved away from should I be using the international investment option or the international endowment option? And it's sort of progressed to more, if I use a specific product, what is the tax consequences potentially for the people that I put in place as nominations of beneficiaries or that takes over the contract. So there's a lot of clients that are looking to immigrate. The question also comes up, should I be using this product or that product if I'm looking to immigrate? And if I'm looking to immigrate to a certain jurisdiction, what product is more suitable, because the tax jurisdictions will be different. So the conversation has definitely moved on from just what product in an SA context, and it's moved on to what should I do if I go to a certain jurisdiction, or what should I do if I have family members abroad and I need to use a specific product.
Thanks, Marius. You touched on some very interesting aspects, but we obviously can't stop at the questions. So Hannes, in your view, how does an advisor take those questions and practically build it into a course of action?
Eugene, that's a great question, and we often are confronted with advisors and clients who feel overwhelmed by this process. So there's 4 things that you can start or use to start this discussion. And the first question is to remember that no one size fits all. You often need to look at clients individually, and this is so important when it comes to this topic. The next question is the tax residency of a specific client. What is the tax residency of that client? We also need to take time frame in mind. Often clients would say, I'm in the process of immigrating, but it's a process that might be 2 years, 3 years, 5 years. And then most importantly, this is a multidisciplinary process. You need partners on board. You need a company such as Momentum. You might need a legal team. You might need an expat specialist. You might need a tax specialist in the jurisdiction. So these are 4 very important starting points in this discussion.
Thank you, Hannes. Artie, I'm sure you are burning to add some valuable points to what Marius and Hannes has mentioned to us already.
Yes, absolutely, Eugene. Thank you. I think that Hannes has hit the nail on the head. There are no 2 clients that are exactly the same, and it all depends on the client's intention. So cessation of tax residency in South Africa for an individual with a temporary residency in another country should be explored further by that client, because cessation of tax residency in South Africa can result in tax implications which would be very expensive for the client, specifically the disposal of a deemed disposal of their assets, which would trigger a capital gains tax event. Therefore, the products that the client may want to invest in could serve the purpose of investing in a jurisdiction that awards them or gives them specific benefits. For example, I spoke a little bit earlier about Australia, and a temporary resident in Australia in fact can enjoy specific exemptions from foreign income sources. Guernsey is a tax neutral environment which can also be quite well serving to the client if their focus is to plan for taxes. And so again, in short, I'd like to say no 2 clients are the same, and one should explore their intent before making a decision to cease their tax residency in South Africa.
Thank you, Artie. I think if anything is clear from today's discussion up until this point, it's not always as straightforward as it may seem to determine a client's tax residency. And I guess most cases wouldn't be as intricate as those we've presented today, but it does really require some additional focus from a planning perspective to put the right plan in place. Now, Marius, looking at today's topic, is there perhaps some sort of roadmap or framework that advisors can already start putting together in their minds prior to dealing with a global citizen, for example?
Thanks, Eugene. Yes, what we're trying to do is to create a visual illustration of what a client and the financial planner should look like. Broadly speaking, we think that clients fall into 4 different categories. You have a financial client that has financial, or a South African client that has South African beneficiaries. You have a non-South African client with non-South African beneficiaries. And then you have a client in SA with beneficiaries abroad, or the investor is abroad with financial or South African beneficiaries. So in that broad terms, they will have different things to consider, and the product solutions should potentially look different. And we're trying to steer advisors and clients in the right direction and give them an idea of what they should be thinking about and what potential products could be suitable in such a category.
Hannes, I think Marius touched on a very practical question that clients often overlook, especially when it comes to immigration, and that's front of mind. They often tend to spend quite a lot of time focusing on the visas, where they're going to stay, where they're going to work, and they often neglect very valuable aspects of their financial plans, as in the transition elements of their financial assets. So how can clients actually focus on that before leaving South Africa to really put together a plan that transitions well with their new life wherever they find themselves?
Eugene, that's very true. Clients sometimes look for complex solutions where there are very simple, straightforward solutions available on platforms. Yes, using a trust, using a company structure can often be a good solution, especially for your ultra-high net worth clients. But clients tend to forget that looking at a platform, and specifically the products that that platform offer, gives you extremely good solutions for or during that immigration process. We have endowments available, we have the LISP product available, so we have choices. And if we look at the ability for us to sometimes move between products, for a client to go from an endowment later on into a LISP or the international investment product, to call it by its right name, they sometimes miss these opportunities. On that point, Marius, you've looked at Australia as a jurisdiction, and I know RT has also spoke about Australia, but from your point of view, looking at Australia, what's your experience of that jurisdiction?
Yes, Hannes, we did spend some time and did some research from an investment perspective. We did find in Australia they have a product called the Australia Investment Bond. It's to a degree very similar to our endowment structure. It has, however, a 10-year term, and liquidity is usually only available after 8 years. So clients should be wary of the fact that even though that there is a product like that, and they might use our endowment, the onus is probably still going to rest upon them to go and investigate whether the authorities in Australia is actually going to look at the endowment, be happy with the tax that is, taken in the endowment structure, and not put themselves in a scenario where they use our endowment and then potentially pay 5-fund tax in the endowment plus tax in Australia. So it's important to do the necessary investigation. But Hannes, in the transition scenario from an Australia as an example point of view, timelines sometimes is very difficult to time and know exactly I'm going to immigrate in 2 years' time or 3 years' time. So potentially for a client, they can put an endowment structure in place now that serves their needs while they are still in South Africa. And as you correctly mentioned, once they do immigrate, and if an international investment option serves them better at that point in time, they can do a maximum withdrawal from the endowment and start their international investment option. Unfortunately, not all people that immigrate actually stay overseas.
That's
so
true.
If for whatever reason 2 or 3 years down the line they decide to come back to South Africa, the endowment that they started with has a loan account, and then whatever money they want to repay and pay off that loan in the endowment would put them back in a situation that should they return, they're in the endowment structure, and then it will serve again their SA needs if they are in South Africa.
It gives a lot of flexibility.
100%. 100%.
Thank you. You really touch on very valuable aspects, and I think if we can just stick to this theme of transitioning for another second and perhaps take a scenario where clients have now immigrated, and in those cases clients often want to break ties with South Africa as far as possible. Now, they often in those cases end up investing on an offshore platform where they have access to hard currency investments and at least have that flexibility to access the money anywhere in the world. Now, a question that we often find is that people are afraid of probate or the estate administration process. Now, whether you have to go through it from a South African perspective or as a non-tax resident in a different country or South Africa for that matter, could we maybe rephrase that question and look at a case where probate actually works for a client's financial plan? Arthi, I don't know if you have any input or values that you want to add there.
Absolutely. A probate process is simply an administration of estate process. So it's the process which is set up to distribute assets within a specific jurisdiction. And in South Africa, we call it the administration of deceased estate process, and that's governed in legislation. And similarly, in any part of the world that you would go to, every jurisdiction has a process to distribute assets. And so I simply say that if you fear the probate process, it is as good as fearing death. And all you need to do is plan for that circumstance. Simply by putting the mechanisms in place, such as we partner with companies that are based in Guernsey to assist our clients to simplify the probate process by simply putting a will in place. It's a quick and efficient process, and one merely as part of their estate plan must create the liquidity as part of their financial plan to pay the costs for the process. So really it's nothing for one to be afraid of. It's a matter of planning.
If I can interrupt or add to that, I think often it is seen as this monster lurking, and one shouldn't look at that or look at it like that. It's actually an opportunity, because the processes in many probate jurisdictions are so quick and easy and seamless that it puts our processes to shame. It creates liquidity. And then, of course, the most important part of MWI products is if you do your planning correctly, and it's not difficult, then you can end up in a situation where you can avoid probate. But even if you can't avoid probate, then you are still looking at a situation where it's not the end of the world. Eugene, back to you.
Hannes, I would like to extend that same question to you, and rather than looking at trusts, let's look at it from a platform perspective, where a client, for example, uses an international endowment wrapper or even the open-ended investment product on the platform, for example.
Well, I think it's important to look at some of the, I want to call it ancillary stuff. You must ask yourself the nominee company of this specific product that you're using. Where is it based? Is it based in South Africa? Is it based outside of South Africa? That plays a role in your decision-making process. I think it's also very important to ask yourself, who are the main role players in this structure? Are we looking at beneficiaries for proceeds? Are we looking at successor contracting parties? Because internationally, these different roles have different consequences. We also need to look at the liquidity of the situation of the product you choose. I don't know if we should perhaps discuss the role players in more detail and how different jurisdictions have a different view on, for example, beneficiaries of proceeds. Shall we discuss that?
I definitely think so, Hannes. I think it's a valuable point. It's part of the product, and it's almost the knock-on effects that often get overlooked that clients and sometimes advisors even miss. So please, if you want to elaborate on it.
So for example, looking at beneficiaries for death proceeds, often in jurisdictions that is treated as almost as a life policy paying out. And typically tax regulators worldwide will look at that fairly favorably. The moment you start using successor contract owners or replacement parties, whatever term you want to use, tax authorities are asking the question, what's going on here? Is there something being hidden? So quite often those beneficiaries, those replacement contracting parties, are subject to a high tax burden, almost a double tax burden. So it's important to bear in mind that when you select a certain solution, to not only look at the client sitting in front of you, but also to ask the beneficiaries who's ultimately going to receive these funds, how will they be taxed on this? And in that scenario, often beneficiaries for death proceeds is a better option than a successor contracting party. Eugene?
Thank you, Hannes. You touched on endowment wrappers, and I think it still baffles me that in a lot of cases there's still the stigma that exists in the financial planning community around endowment specifically. and in a lot of cases specifically focusing on the liquidity aspect of it. Now, is that still something that hinders a financial planner or a client, for example, to consider this product?
In our experience, no. The way we structure liquidity inside our product by creating subcontracts means that there's a lot of liquidity in the product. Bearing in mind that investing long-term or investing offshore is about long-term investing. But clients need that warm and fuzzy feeling that if I need to make a withdrawal, it's going to be possible. Of course, we have the legislative rules, the 20% and 5% rules that can play a role in this discussion. But in general, to answer your question, liquidity is very seldom a problem in our products.
If I can add to that, maybe, Eugene, is that, you know, the liquidity might be important for somebody that's transitioning as well. They are uncertain which product to use. I think that stigma comes from endowments typically only having one interest-free loan and one withdrawal within that 5-year restriction period, whereas Hannes mentioned you got the 100 policy structure. And if you are using an endowment for whatever the reason is, including a transition period, you have liquidity before you immigrate. And once you've seized your residence here, your tax residence, living abroad, that doesn't mean that the liquidity disappears. It will be there because it's a rule of the product. So if you need the liquidity pre or post your transition, or for whatever other reason you're using that endowment, it is there, and I think it's quite handy in most circumstances.
Yeah. And Marius, if I can add to that, payment can be anywhere in the world, obviously in the client's bank account. So it solves that liquidity question of how do I get funds in Australia, how do I transfer funds? It's part of that solution. Over to you, Eugene.
Thank you very much. I think if I can highlight what you just mentioned, is the flexibility is there, the liquidity is there, and in a very simple structure. Nothing fancy is needed to get a client to a specific outcome. Just before we finish off, I would like to ask each of you to maybe leave us with a couple of points, valuable snippets that we can give to our advisors. Arthi, perhaps we can start with you and then finish off with Hannes and Marius.
Thank you, Eugene. I think the big takeaway from this is that there's never two clients that are exactly the same. We have a host of documents to complement your advisory process as a financial planner, to understand jurisdictions and to be guided in terms of understanding the next steps in the advisory process, and that the planning is important. Because no two clients are the same, your solutions are not going to be the same for each and every client, and therefore you have a host of resources in individuals that are available to support and serve you. Thank you.
I think from my point of view, whatever plan you start with is probably not the plan you're going to finish with. And I think if I can leave the audience with anything, is that we have the endowment and the investment product. You might start with the endowment, you might end with the investment and go back to the endowment. You might start with a structure because your beneficiaries are in a certain jurisdiction where successor is better, but they might move to another country and then successor needs to become proceeds. So the flexibility of our products, I think, will cater for most of the clients' needs out there.
Thanks, Marius. The word I want to leave the audience with is the word that I also used at the beginning, overwhelmed. Don't feel overwhelmed when you're sitting in front of this client, confronted with this new planning experience. There's resources available. We are there to help our clients and to help our advisors. So don't walk away from what could be very good business.
I have to say thank you to each of you for your valuable insights into today's discussion. I think it's great that we live in such a dynamic time where financial planning has probably never been more interesting and more dynamic. And our advisors still play a very integral part in this whole setup. I think that's not going away anytime soon. And if anything, today's discussion just highlighted that again. We unfortunately must end our discussion here for today, but please do join us again in future as we extend our global citizen discussion.
Thank you to our panel for those interesting perspectives on today's topic. Building a solid advice framework clearly has a lot of elements to it. And as a business, we would like to help you formulate these frameworks to build long-lasting relationships with your global citizens. Please remember to watch the full session and add your ID number to the CPD section so we can verify your attendance. I look forward to the continuation of this discussion in future. I would like to thank each of our speakers for their contribution and also to our advisors for your attendance. We value your time.